Yeah, unfortunately, boss, I mean, you're here if you want to say anything. The connection, the audio of X, unfortunately, has degraded a little bit. I've had some issues. You know, we do a lot of spaces here. So the audio was not as optimal.
Can you hear me?
Yes, sir. Yes, sir.
I just want to get a feedback on if I was able to talk about the points about the narrative, the timing, and the utilization of which liquidity pool under what circumstance. Was I clear in that presentation at that part or
That
no?
was difficult to hear, and honestly, as we convene together as traders, it would be wonderful with the quality of audio that we have now to go over or to reiterate some of the time and the time elements that you were incorporating within, our heart of the community. I think everyone here would be very grateful and appreciative. The audio, unfortunately, Michael, was not optimal. And we did hear, and it is very listenable to go back to, but it is not, it's just not pristine, unfortunately. So,
Yeah, I don't usually look at the comment section. Like I go into a zone and I'm just going on. But if I would have known it was, chopping or not delivering as I was hoping it would be, I would have done something differently. But I was in my element and wasn't able to see it. But if you could allow me to, I'll make a very short, right to the point video with it. But if you guys are here, you got any questions you want to ask me? I got about 10 minutes if you want to have a go at it, or if Kit wants to jibber jabber.
I mean, I would love to talk with you, boss, for real quick. I mean, I heard and I was really excited about listening to is it from an old school forum? So I'm an OG guy here, right? So I'm going back to some baby Pips days, okay? If you don't mind, okay?
Sure.
So some of the young folks here might not know of your community from back in the day. So anyway, amongst your community back in the day within baby pips, there was two macros that were talked about, one being at 403 to 430. A nascent range in impulse with a distribution off of the 430 price and treating it like a macro. There were two specifically that came out of London in the baby pips days within your time frame. There was one from 2:33 to 3 o'clock, a 27-minute impulse, and then from 4:03 to 4:30. Myself and a few other ICT OG traders definitely trade this range, but I found it fascinating today, your correlation even within your macros and fractal distribution of like the 50-10 and the relationship of the 11 o'clock price with the that original nascent range, we'll say, versus maybe, I don't want to call it a reset or almost a retrace of said algorithmic delivery. So I don't know if you could touch upon anything at all within maybe what you were saying there. I heard you mention a time, it was like 4:16, it was a 106-minute range. I think you referenced. Would you mind expounding on that idea, sir?
Well, let me briefly state this. During baby pips days, and anybody that's been with me for the entirety of me being since at that time to the present, I've mentioned it several times that I was actually revealing everything from journal to presentation, my exact progress of where I was at, the things I was using that led me to my present understanding and what I am able to employ. So you were getting right directly from journal entries from the 90s being presented in baby pips, encapsulated little portions like breadcrumbs. So they were not refined in the sense that here's what everything is in its final form. It was me slowly. You remember something on baby pips? What I did one night, I was literally watching a movie and really wasn't interested because my wife was watching this rom-com with me, and I had no interest in this movie. So I was looking at my phone and looking at my computer, and I was thinking to myself, I got an hour more of this movie, and I just can't get into it. So I was looking at baby pips, and I saw all these people coming out there all the time saying, this is what you do, this is what you don't do. And it was bullshit, nonsense. So I said, I want to see if I can create another of me. If I put out there in the same timeline everything that led me up to where I am right now, If I put people in the incubator, the test tube, if you will, look at this, focus on this, and do this, do this, do this, do this, and then spoon feed out in incremental delivery of what it is that I went through, could I create that same outcome of ICT 2.0? And so it was like a social media experiment on my part. I wanted to see if everybody was given the same things to focus on in the same order that I did, will the results be the same? And honestly, it hasn't been. It hasn't been the same. And that's not a mark against me as a trader, teacher, mentor, whatever. It's just the circumstances just didn't create the same outcome that it happened for me. So anything that you're asking me about, what it is I taught about baby, because you think about it, I don't have any mention of that material. Like, I bring nothing to it. I never say, go to look at this anymore, because that was all infancy of my understanding and learning. So by presenting that to the community on baby pets back then, I'm the same guy right now that I was there, and calling highs and lows and doing some of the executions back then. And I was wanting the people that watched that to be inspired to continue to study what it is I was presenting. If you remember, I wasn't really teaching the things I was executing on. I was doing other things, because I knew that would be the hook to keep you in there watching, but still going through the process of learning what it was I was bringing out slowly, incrementally.
I mean,
So,
but you very clearly were and have been an outlined fractal delivery, right? And time-based fractal delivery. And that's like what I don't want to say is a false dichotomy, but you've really simplified a very complex concept by presenting it in a very easy way for folks to conceptualize and understand. So the fractal delivery is what you've been doing from day one, right? And the time-based fractal delivery, and understanding the correlation between that, and seeing those early days and how you've expounded upon that just as a OG. Like I said, you know my story, right? Like, I found you through, alleys and CDs and like negotiations with folks of like black market kind of stuff, but that's kind of just what it was. And finding the internet coming out, and then just how you've evolved within each one of your mentorships, and how it really, in my view, as again an OG listener and follower of you for a long time, that just the way that you've expounded upon time. And anybody that trades with you to some degree is going to understand liquidity, the liquidity paradigm. They can understand market structure if they'd like. They're going to have an opportunity to really delve into what is algorithmic fractal delivery, and the different time frames that you kind of go over, and the kill zones. And I mean, you offer or present an Asian protraction, you offer and present a London protraction, you offer and present a New York protraction. I mean, you very clearly lay out within models through market makers and through your standard deviation theory. At least that's what I resonate with, mate. Like, I just want to say, like, through fractal delivery and what you do, just from one OG student to, a mentor, that's really what resonates with me, and how you've taught over the years, and how you've really carried that into even more refined time within fractal delivery.
Mm-hmm. That's awesome. I'm glad that's what you specialize in. But as you can see, there's lots of things, and if people don't really resonate with that aspect,
you're so correct.
It's literally not saying that just because you don't see it that way or have an affinity for that portion of it, that you can't find something that's applicable for your own trading. It's a wide array of things that you can form fit to yourself based on your personality and when you can engage the market price.
You're right. That's like the 3D version of all of your teachings, is because it's form fit to an individual's personality, right? Because you have so many, I would almost say like a Rubik's Cube, or an angle, or a fit for a person to find a way to resonate with a model, or even a logic or a paradigm towards how their approach will be within, again, for me, the overarching theme is algorithmic theory, algorithmic principle, fractal delivery. And those are overarching themes, I think, that are more of an advanced student, maybe someone that has followed you for a long time, aka maybe a charter student, versus someone that might be learning from you today.
Well, I will say this, by privacy, I can't reveal who I'm referring to, but they know who I'm talking about. I have 7 individual charter members that have gone beyond the scope of what I taught and what I hinted at in a lot of things. But there's only so much I can go without causing personal issues in my life that I don't want to have to deal with. But they have done things in the direction and the little subtle hints that I lay down in some of the content. I point to spend time doing something here or start doing something here. I can't get in trouble for that. There's no way that anybody can say, you did, no. But the students have gone beyond that, and they have not wrote a book, okay? Javi, I know you probably are listening or will listen to this. This is no dig against you, okay? But I get so many people asking me if the stuff in that man's book is what the algorithm's doing. And again, I just had it again this over the weekend here. There is no correlation, zero correlation to what it is that I'm trying to showcase to you without saying, here it is, folks. None of those things have any relationship whatsoever. But I find it fascinating. I think it's a wonderful, side quest. But if it really was it, I would tell you. And it's not a knock against him. It's not a way of suppressing any kind of income he can make off of his book or any future writings that he does. I'm just basically saying that that's not it. Okay. And if it was, I would be honest and tell you. But I do have 7 students, he's not one of them, that literally are on the right path. And they know it because we've communicated. Okay. I've told them, I said, don't talk about it. Don't share it, because what you're going to discover if you keep doing what you're doing is so close to what it is I can't show you. It's too good. It's too good for public consumption. It really is too good. And some of the things that you're doing are very, very close to that. So you're not just simply saying, well, ICT said this, so I'm only going to look there. I'm only going to do what he said there. There's times where I've mentioned and hinted saying, spend time looking at it like this. I did it today in the presentation. I hope it came through when I was talking about the 15-second inside of the
if you wouldn't
9:30
mind
to 11 o'clock in the
reiterating
morning.
that point one more time, mate, I promise you the audience will appreciate the sound quality and you reiterating that point. Pretty please.
Sure. If you look at the market on a day-by-day basis between the 9:30 opening bell to 11 o'clock in the morning, always Eastern time, and from a 1-minute perspective, considering the market structure and all of the ebb and flow that's seen on the 1-minute chart, there's a lot of things that are going on inside that 1-minute chart that people can't see. They don't have any understanding of what's going on. And even if you're not someone that's equipped or even inspired to look at those lower time frames because you've seen other people say they're noise or they're too choppy or they're just useless information, that to me is a dumbass cop-out, because what's the difference between whether you're watching that price fluctuation on a 5-second chart, 1-second chart, tick chart, 15-minute chart, 51-minute chart, hourly chart? Isn't the same fluctuation from tick to tick the same thing, whether you're looking at it from one time frame to the next? Is the market somehow different? I'm asking. I'm not doing it rhetorically. I'm asking you.
No, it's fractal delivery.
It's the same price.
Yes, it's fractal delivery.
It's the same price that's being delivered the same way. But when we look at it from a very short time frame, like sub 1 minute, the perspective that the algorithms are referring to, because they're not just keying up on a 15-minute this and that, or an hourly this or that. They're in there firing all day long, buying and selling, buying and selling, buying and selling. And they're trying to capture fluctuations in disparities between price. So if we go in, not under the guise of, I'm going to try to take every potential trade that's available to me. That's not what I'm not trying to inspire that. But what I am trying to tell you is, if you spend time between 9:30 in the morning, opening time for equities, to 11 o'clock, it's a very static 90-minute time period. It's not a cycle. It's just a very static portion of price action for the intraday range. If you spend time looking at that, and you look for relative equal lows when you're bullish, see them on a 15-second chart. Note when they form. As soon as they form, note the time that it does that. And then how long does it run away above those before it starts to come back down? And when does it run those relative equal lows? By keeping a journal of when those things occur, you're going to start seeing an overlapping of a very specific element that I'm not going to come out and say, here it is, but you will see it. You will see it. It's undeniable. And you will see why I've waited on these live streams and when I'm broadcasting and calling candlestick by candlestick, why I'm not referring to any specific candle that you're questioning me about. It'll be obvious, and it will help you understand why the daily candle is creating the lows, the short-term lows, why 1 minute candles get ignored, why fair value gaps stay open, why are other candles more salient to others on a 1 minute, 2 minute, 3 minute, 4 minute, 5 minute basis. Why am I only looking at that one? Because you're going to get the answer inside that 15-second chart. You can still see it on a 30-second chart, but as I mentioned in the presentation, but I'm not sure if it was coming across clear or not, I personally use the 15-second chart for that purpose. So when I'm talking and calling candlestick by candlestick, when I'm doing it in Telegram or when I was doing it on X, I have that 15-second chart in front of me. My phone, I'm putting the information out in public eye through that medium, but I have all of my monitors, showing me all the time frames I'm looking for with all the pertinent information I'm watching, but I'm watching that 15-second chart because I'm understanding that if I'm bullish, my bias is bullish, I know that I only want to be looking for price runs that's going to happen after a sell stop raid. That's like rocket fuel. It's like pouring gasoline on a fire. And when you want to see the real secrets behind what it is I'm doing, when they're like, wow, how did you know it did that? When I'm calling out there publicly, read the comments. They're like, how did you know that? I taught that today. I'm showing you what it is I'm doing. And when I'm bearish, I'm the same thing I'm doing. I'm looking for 15-second relative equal highs. When they run up and bump that, and I'm bearish, I'm waiting for everything I teach you to unfold there and then work its way into the 1 minute chart. And then that 1 minute chart works its way into a 5 minute chart. And all of the order flow, the price continuum delivery is seen from time frame from 15-second up. Then you get the daily candle delivery as it should be. But as a real foundation to understanding why a daily range forms and ways that it forms, like why does it go down to a specific low? Why did you expect that low and not this one? The rules I gave, were based on economic calendar. They were based on pools of liquidity that cannot be hidden from you. Asian session lows when you're bullish, they're going to go down there when it's a high impact news driver, usually at 9:45 Eastern time or the 10 o'clock news drivers. They really want to wash those individuals out. And they know, especially if the market's rallied from Asia's open at 6 o'clock in the afternoon or evening time, Eastern time, local time, which essentially is the same thing as a restart in equities or index futures at 6 p.m. Eastern time after our 1 hour break. If we see that the market has gone like a 45-degree angle or just continuously moving higher from that period of time, but you have a 9:45 or a 10 o'clock news impact that's going to be high red folder, not medium impact. It's got to be high red folder news. If that occurs, then I'm anticipating those Asian lows, if they're relatively equal, they're going to come all the way down there for them. I'm looking for that. Now, when we use the London lows, a medium impact driver can see that happen. When I'm bullish, I'm looking for the lows below London to be washed out before the price rallies up when I'm bullish. Any other time, any other instance, is when there is no news driver. They can still take it down to London, but it's based on where you're at in the premium to discount portion of the range of where you think the market's going to go to. So as a case study, as an example here, let's say it's Monday's trading and it's 7 o'clock in the morning and there's an absence of any kind of news on a Monday. But we are in the discount portion of a range that you think is going to deliver over the course of 300 to 400 handles. And I'm not saying that number of handles is essential to this being true or not. It just means that whatever your weekly objective is, where you think the weekly range, one single candle for the week, is going to go up to or go down to. In this case, if it's bullish, there's no news on that Monday. I still would anticipate London lows being taken out, especially if they're relatively equal, if I'm bullish. If I'm bearish, I would expect London relative equal highs to be rallied up to, and then the real move comes. So when you have the pre-market session between 7 o'clock in the morning to 9:30 in the morning, okay, those are generally every session always a potential. So without saying, I mean, if it's going to go to London lows or if it's going to go to Asia's lows, it's going to go to the pre-market session lows, right? I mean, that goes without saying. But when do I limit my understanding about entering that trade? What's the green light go to only focusing on whatever the liquidity is that's formed at 7 o'clock or after? It's when I'm in the upper portion of the price run I think is going to be delivered for the weekly range. So if you understand discount to premium as I teach it, there's very little retracements as you get into the premium side of a price run. So if you know what you're looking for, you're not going to have deep retracements in the upper half because they're not going to allow retail Rick, as I mentioned today, to get a deep discount. They're not going to give them the opportunity to get in. So it's going to have them feeling like they have to chase price. And for people that are disciplined, they let those price runs go because they feel like they're chasing price. In the delivery, when it's below equilibrium of whatever that price run is you think. So what starts the move and what ends the move in a perfect world for the weekly raid on buy side or trading to an inefficiency that's in premium. Whatever that range is that you define for your weekly objective, like I framed it based on what I showed you this week. Once it hit it, I was not interested. Even if non-farm payroll wasn't a factor this week, I would not have traded on Friday because what I opened up the week with wanting to see it delivered to, it delivered. So I have to have boundaries. I have to know this is as far as I'm willing to go in there in this current climate. So knowing which pool of liquidity you're going to be aiming for and why is essential, and it's crucial to be trading with the current present narrative. Knowing how far it's going to go down when you're bullish before it goes higher. Because all of the cleanest price runs, the most ferocious, the most explosive type sustained price runs, always, without fail, will happen after an opposing liquidity raid. When you're bullish, sell stops will be rated, and then it runs. When you're bearish, buy stops will be rated before it drops and runs. So when you can bring all these ingredients together, where your higher time frame weekly chart, you're really bullish, you think it's going to go to an objective. I've been teaching that since I've been teaching as a mentor, how to determine that. But the confusion is where students and traders that come into my listening range, they say that I complicate everything and just tell me the bias. What's the easy way about bias is easy. Are you bullish or bearish? And you just anchor to a weekly chart based on what you think it's going to do there. That's an easy thing. But that doesn't translate to knowing how you're going to work with that bias intraday. And that's why you get the Goldman Sachs boys that come out there and they'll say, anybody tells you to trade a 1 minute chart, run away from them because they're con artists. Nobody can do it consistently. Nobody. And here we are, a community that consistently fucking does it. So they want to ignore that. They want to pretend it's not there. But I'm telling you, focus on these things, okay? Because like I've done all the time as a mentor, I'm not telling you something just to believe it because I said so. My whole reputation has been built on the fact that this is what I'm telling you to go do. And you will see that in the price action. You will see the evidence. You will find it in your own hands, and it's undeniable. It doesn't matter what anybody else says about it. If you see it happening over and over and over again, is someone going to change your mind about what it is you're seeing? Fuck no, they're not going to change anything. You can see it. Once you have that underneath you as experience, no one's going to tell you that it didn't happen, that you've been watching it for months and years and you're able to make money off of it. Someone's going to argue and tell you that you've been using the same logic to nail down the low of the day and then ride that son of a bitch all the way up into the afternoon. And then the benefits of understanding that 2 hour window between 11:30 in the morning to 1:30 in the morning, 1:30 in the afternoon Eastern time, that 2 hour lunch period, knowing that if you're bullish, then all we're going to do is look for the low that formed at 10 o'clock Eastern time, going into where we had traded for that 2 hour period. During that 2 hour period, it's going to come down and blow out that 10 o'clock low. That's the lunch macro. That's exactly what it does. That's why it's there. It goes down to do what? To unseat those individuals that were fortunate enough to get in, but also too aggressive by trailing their stop loss right up to that low at 10 o'clock, or the low that forms after 10 o'clock. That's why I tell you that New York lunch window Whatever that 10 o'clock low is when you've been bullish, whether it's going to reverse that day and go lower, or if it's going down to take the stops, that is an easy trade. It's an intraday contrarian setup. So if you have a contrarian perspective, if you're someone that's contrarian, that just like to go against the grain, miss the initial move of the day in the morning. Miss it. Intentionally miss it. And then at 11:30, start anticipating a drop down into the low that formed after 10 o'clock. And you will have an 85% likelihood of finding bread every single fucking day. And you don't have to be in the portion of the biggest part of the day. You don't have to be right about this or that. It's easy. How do you get into it? A silver bullet, 1 minute chart, 30-second chart, 15-second chart. They're there every fucking day. They're flawless. Zero instances where it does not form. It's there every fucking day, every day. But the one, as I mentioned this morning, where it's a trending day where it blasts off and it just does not come back. It just keeps going and going and going and going and going. Those days, unless I'm pre-session, in there already, I'm missing those days. I'm missing it, which is the reason why I teach you to spend some time in that 7 o'clock to 9:30, because if you get real comfortable trading pre-market session, those tigers never slip out of your hands. You can grab a hold of their tail, and when they blast off at the opening bell, and it doesn't even worry about the opening range, it doesn't even worry about first presented fair value gap, it doesn't even worry about silver bullet 10 o'clock, it just keeps tearing people's face off, keeps going higher, 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 higher. The only way you can participate in that is to chase price, which is completely alien to what we do, or learn how to be positioned between 7 o'clock and 9:30. Pay yourself a little bit, roll a stop to something, so if it stops out, who cares? You can get a nice dinner, paid to you for your participation, and just let it go. Let it develop. If you don't spend time with trying to formulate a long-term bias where it's likely to go to, you're never going to get these monstrosities of windfall profits. Those will never happen for you. They don't just happen consistently by blind luck. The people that do the time in charting and looking for these weekly charts or the daily chart that has a sizable swing objective above or below, those are the traders that are preparing themselves to see that. But then you have to do a lot of other things, which is weigh out what liquidity is going to go for. Well, without the economic calendar and an understanding of where you're at in that range of the implied delivery of that range of objective you're reaching for, that range between where you're at right now and where it gets to, that's an implied dealing range. It's not there in the chart yet, but you have to be able to see it as if it's going to be there. And then where you think it's going is terminus. At the end, that's the best case exit strategy for you. Measure that. If you're in the lower half of that when you're bullish, all the things I mentioned about the London low and the Asian low are true. But as soon as you breach equilibrium of that implied dealing range of where you think the move's already underway, okay, it's already, say it's like Wednesday or Thursday, you're going to see less likely for London low and or especially Asia's low being swept before it rallies again. Any other day, I'm looking for the liquidity at 7 o'clock in the morning to present 9:30 opening. That's like, if you're just going to look for a very obvious pool of liquidity that's going to aim for just about almost every single day, it's that liquidity between 7 o'clock in the morning and 9:30. Just study it. Don't take my word for it. Don't listen to me and say, well, there it is, that the gospel ICT said it, so therefore I ain't got to go and back test any of it. No, take what I said as a guideline and say, okay, I'm going to look at the NASDAQ or the S&P or the Dow. I don't like the Dow, but you pick your index and go through it. If you're a Forex trader, it's the same logic, folks. It doesn't change because it's no longer index futures. It's the same thing I was doing with Forex. The problem is Forex is kind of sleepy right now. It has its one little hit wonder, but everything else is like, it's cloudy. It's not worth my time trading the ranges.
What do you think about, mate, real quick, what do you think about the commodities? I've been looking at natural gas and I see an explosive move up into the $4. We've already had this distribution phase start. What are your thoughts on traders kind of focusing a little bit more, for example, on the metals and the Asian protraction with the large ranges that are being distributed through China and global distribution and really how some of those models are really printing right now, right? Like gold in the Asian protraction is a lovely model for traders to trade. You know what I mean?
Well, as it relates to commodities, they are directly related to real supply and demand factors. And because we have a pending Taiwan invasion by China, we have all the stuff that's going on over in Ukraine. It's unfortunately going to be continued. Okay, they're going to keep that going until this administration's done because that's a cash cow for them. They keep doing it. They keep pushing it. Keep pushing it. But there's other things that are popping off. As I mentioned, like India and Pakistan. All these little theaters of war are collecting into what we're going to see as World War III. And when that pops off, energies are going to go nuts. They're going to go ballistic. Gold, I told you last year that it was going on 3,500 to 3,600. That's my target. It went to 3,500, I think it was, recently. And then we're having that little retracement again. Gold's not done, in my opinion. And if we start seeing an escalation in the fevered pitch of being in a more global scale war, I mean, that's going to dogpile gold above 5,000. Like, who knows where it's going to go, because even it's been suppressed. If they let gold be valued as it should be, and silver too, it would be higher than Bitcoin. At Bitcoin level prices, it would be above that. So they suppress those things. But when we go into World War III level stuff, and anybody that hears this stuff and they think it's fear mongering, listen, I'm telling you, so you can prepare for it. So that way you're not surprised by it. You're not scared, because those types of things are actually scary. I don't want to see it I don't want to see it unfold. But those things, unfortunately, yield wonderful opportunities to profit from. I don't want to see people die. I don't want to see wars. I don't want to see droughts. I don't want to see all those things. I don't wake up and think, man, I hope the world comes to an end today. That's not what I'm saying when I tell you to be mindful of it. But as a trader, you have to be mindful of it. And metals are going to go continuously higher. Energy is going to explode.
Yes.
As soon as a wider theater of war opens up, it's going to go
oil and natural gas.
bonkers.
I'm extremely bullish on both of them, sir. Just I couldn't agree more on that statement.
The day that your newswire flashes that we have dropped bunker busters in Iran, and you're going to see it soon, oil is going to go fucking like go through the roof, and who knows where it's going? Like, who knows? $300 a barrel is not unheard of in a situation like that. I mean, it's a powder keg ready to go off. But the issue is timing that. Timing that is very, very, very difficult, because it's event driven, just like gold is event driven. So I get questioned all the time. Well, why don't you trade gold? Why don't you use a model? Give me a gold model. I've already given you trading models. But I'm comfortable with the volatility, the time delivery, all the things that happen in my markets of choice in the present climate. It's not that I'm against trading gold. It's not that I don't think you can make money with gold using my concepts. I'm just comfortable doing what I'm comfortable doing. Remember, I don't have to do any of this stuff. I don't have to make money from markets. Like, I'm already well-to-do. I'm blessed. But if I'm going to show something to students, would I reach for things that I wouldn't do with my own money right now? No. So if I'm going to be honest and come out and say, okay, if I were doing this and I needed to make my ends meet, what market would I be trading right now, and how would I do that? That's exactly how I teach. I'm not trying to prove that here's a handicap. Here's the hardest thing I could possibly do right now, and I'm going to show you how formidable I am and how proficient I am with trading in the worst conditions the history's ever known in terms of trading, because of the level of volatility. I can tell you honestly, there's many times I've thanked myself for not having participated on certain days, because I would have lost. I would have hurt myself, because even knowing that I see something in the price action, even though I see it's there, something inside me by experience, and that's a very hard thing to articulate to somebody that's not been doing it long enough, or trust the educator. And I'm going to place myself in that role for a moment. If I tell you something and I say, I'm not comfortable doing that, unfortunately, social media says, well, guess what that means? I'm going to go out here and do it, and I'm going to say, remember how ICT says don't trade on Mondays? When I only stated that if you're a new trader and it's not non-farm payroll Friday, that week, Monday is usually a day where I'm watching to see if what I'm anticipating is starting to build up. So it's like an accumulation day for what I anticipate the weekly range to do. And I'm okay if I lose 20, 30% of the weekly range objective on that Monday. I don't care, because I know that it's really showing me what I wanted to see is likely to happen.
Especially
But social
as
media,
you reference students to the NWOG, and as you've introduced that over time as well, like the gap theory that you've introduced, mate, it has been so spectacular for someone who might be a newer trader in some of your earlier content where they might not have had a model towards the trade that early part of the week. With the NWOG and your introduction of these models in latter parts of your mentorship, then you're really opening up that trader to apply the model to that said range, right? And I personally love that. Like the NWOGs are so important for draws on liquidity and then early parts of the week within reference towards Friday's range and or the gap formed, right? Especially on non-news catalysts within liquidity injection, right?
I would like for you when we're done listening to this old man talk a little bit. I would like to hear others here if they've noticed a new arena of opportunities in intraday trading when they employ the new day opening gap and or the new week opening gap. When more than 20 to 30 handles in proximity to either one of them, and we can see that the structure of the market has changed to afford a retracement, they're like no-brainer trades. Like they're literally like they're just saying, "Hey, look, you got some free money over here. You want this?" And there's a lot of these types of setups that I let go because I'm waiting for something else. It's a bigger magnitude move or something I'm trying to teach for that particular session or that week I'm trying to focus on. But I let them go all day long, all the time. But I would love to know if the listeners here are able to see or have they've noted a increase exponentially in the level of opportunities that they see now by having that on their chart, because I'm convinced that if they spent any time doing it, it has afforded them more opportunities than they ever noticed before.
Feedback from the community, it's being requested. So speaker tag is there, it's available. We're going to go through, we're going to cycle through some folks.
Sir, can I say I raised the
Calm
hand
down, I'll
first?
call you Mr. Illiquidity. Do not interrupt. All right? There's a method in order to how we do these things around here. Pretty please put yourself on mute. Thank you. We will call upon you per person. You'll have an opportunity to describe what Michael is requesting, and then pretty please keep it short and sweet so we can get feedback from the community, which is what Michael is requesting. Okay? So go ahead and mute yourself, Mr. Liquidity. Thank you. And Alex, you're up first.
First of all, good morning. Good morning, every day.
Good morning, buddy. We can hear you loud and clear.
It's a nice. I hear here.
I can't.
Yeah.
Okay, wait. I'm not sure we can hear you, buddy.
Can you hear me?
Can you double check?
Start over, please.
Yeah, we can hear you. If you have a Bluetooth, turn it off, everybody. Speak in the microphone of your phone, or make sure that you're eliminating outside noises. Pretty please. Anyway, please, Alex. Yes, sir. We can hear you.
Nice. First of all, I want to say thank you to Michael. To ICT, who was really what he thought, what he said. He's really saved my life. He saved my life from a lot of things. I learned his concepts. I was being day and night learning all he taught there, and I was be day and night taking notes, backtesting and watching it, because I was back in the days. I remember when I started trading, the trading was very hard for me, and
how are you mapping and utilizing these ranges, my friend? I love you.
Yeah.
So, Kit, can you can I just say something real quick?
Yes, sir.
So
when folks come forward, you don't need to spend.
Your connection has lost.
I appreciate your respect and all that, but you don't need to say all that. It's needless. You can do that in a post to me. So I don't want to act like a celebrity.
Right.
I don't want you to treat me like a celebrity. We're just having a conversation.
Just real talk. Just as he said within the space that I did here, was that you really were enjoying how you were able to deliver a message to folks, just like you were sitting in the living room, like you did in the 90s. Like it was just a regular conversation as an OG mentor being able to connect with folks and get their feedback, as this is what this opportunity is. Pretty please, if you are afforded the opportunity to speak, it's not about lauding him with praise. It's about having a regular conversation. And we're really, right now, we're trying to talk about price. We're really talking about some very good mentorship details with folks that want to understand these concepts. So pretty please, let's stay focused as a community with what is being asked of us. And that is to map out and provide feedback on what the mentor has provided as far as open ranges and opportunities in which to execute in current content, within current content, current market conditions. So again, pretty please, Alex, one more time. I'm coming at you, brother. Then we're coming to Focus next, and then Sam.
Okay, so I will have just one question, right? On that, let's present the further gap, right? After we sweep a low, for example, we sweep a low in that range, 930 to watch that new window. When you measure that 90-minute window, right? I really incorporate that with my
I
mom,
really, and that's it.
and I want to understand how really works, because sometimes I get confused sometimes,
So whether it's going to invert the size of the range, or you measuring the tick of the first presentation fair value gap, or you noting if there's a SIBI or a BISI, details maybe someone, a more advanced student, might have for the mentor. But a question nonetheless, Michael, is I think he's trying to understand more or less how to maneuver around the first pres. Is that correct, Alex?
Yeah.
All right.
Exactly.
If you don't mind, Michael, I know you presented this stuff in the past, and we as your students understand their levels of understanding within your presentation of knowledge.
I didn't hear a smooth presentation of what he was specifically asking for, so I don't even know how to address what he asked. So
Fair enough.
give him another chance to say it, because I don't want him to feel like, because we opened up with him saying, "Don't talk to me."
That's fair, bro. Right on, mate. I think he appreciates the opportunity. So, Alex, pretty please, if you don't mind, would you restate your question for Michael? Your mic is muted, Alex. We're going to come back to Alex. We're going to keep it going, keep it flowing. That's what we're here.
Yeah, give him another chance.
We got him. He'll unmute his mic and he can step back up whenever he likes. If the speaker tag kind of stays mute, then you there, buddy? I can't hear you, Alex.
Go to one more person.
Yeah, that's what we'll do, buddy. Do me a favor, Alex. Power down, power up. Come on back. X is undefeated. You know how it works. We got Focus here. We got Sam here. We're going to keep it going, keep it flowing. It's unfortunate, Alex, we can't hear you. So power down, power up, pretty please. And Focus, we're going to go to you next, buddy. You there?
Yeah, man.
All right, brother.
Not so many about his questions. I guess I wish I'd had something more specific to ask, but it's helped me tremendously with having those 9:30 presentations framed, because the One Trading Setup for Life became my foundation for everything. Like that video, since it's come out, I preach it and tell everyone, like, to find a narrative and a storytelling. Like I utilize that through my higher time frame analysis, but utilizing the first presentation AM and PM, the one after at 1:30 after and 9:30 after, have helped me, because I'm always looking for the 2022 model, like you were specifically saying, that engagement of liquidity that adds the rocket fuel for the next move, and framing it through, a breaker or a failure swing, being the two types of swing points. So once I have my first presentation and you emphasize that, and I could collectively put that with what I was already doing from the morning sessions, looking at the liquidity-based time ranges, the session liquidity, what am I looking for the weekly protraction to do? Where are we at based on the monthly order block sequences that occur throughout the year? Like, what is price doing in that flow? It just really gave me a more structured piece, because my whole framework of looking at price was the 1 hour chart, like you said in that tweet. If you treat the 60-minute chart like the daily chart, a whole new world opens up to you. And I took that as a personal challenge to duplicate the fractal. And if I could do it thousands of times off of that understanding, then my long-term narrative would just expand and I could start seeing those higher fractals. So the first presentations that you gave helped me tremendously in not worrying so much of win, and being like a pit bull, like just ready to attack. That no, it's okay. I can utilize it here. If I miss it, or if it just taps in a run, or maybe it's a breakaway and it doesn't even come back to it, that's fine. Because where are we at in that session liquidity sequence to prepare for lunch and PM? Because I know the bus is gonna come, like you say. It's gonna give me that same fractal opportunity, and just wait for that offset to occur and take advantage of maybe the end of day macro, or maybe that 9:30 run on, say lunch engineered liquidity. So I'll use that PM session first presentation as, all right, there's the elephant in the pool. Now I can get in with some confidence in a low risk buy situation and take advantage of that distribution. So just those two pieces, I would just have to say, really helped me, along with that one trading setup for life, for doing those intraday models and really having something that I can securely like fasten my seatbelt to, and not have to spend hours and hours down the rabbit holes that I have, but that some people might chase that shiny object. So it just really helped me tremendously in that sense.
Can I ask you a question?
Please.
Since your affinity is for the first presented fair value gaps, based on what I was suggesting today as a mode of study, do you either have examples that you've seen this before, or do you have an interest in pursuing what I've outlined today, where if you have done the work and you think that the higher time frame bias is bullish, and you now have the understanding of when using the economic calendar and where you're in the range of that higher time frame run, whether it be premium to discount, there's rules I've given today that help you formulate the expectancy of which liquidity it's going to tag. Asia's lows, London's lows, or pre-market session between 7 o'clock and 9:30. Given that new perspective, it may not have been new for you, maybe you've already been utilizing it. It's never not the first time I've mentioned how to use the inversion fair value aspects of first presented fair value gap. But now I've given a codified roadmap of, this is what I'm looking for, and if it does these things and runs out that liquidity and trades back above the first presented fair value gap, I already know before it even does this that it's going to be treated as an inversion fair value gap that's bullish. If it was like a SIBI, in other words, if that first presented fair value gap between 9:31 and 10 o'clock in the morning, if it forms on a down close basis, sell side imbalance, buy side inefficiency, and you're bullish, and it takes out the liquidity pool that you are expected to do based on the rules I've said today, isn't it more comforting knowing that you're not going to use that as a selling premium array, but you're going to wait for it to trade up through it, come back down, and prove to you that its lower half is not being engaged anymore. And then price runs from that point on to the higher side, whatever near-term buy side would be there. Can you see how that's advantageous?
Yes, sir, 100%. Because from that perspective and seeing it happen, knowing that can be the entry model in itself, I can start framing immediately from when I see lower time frame liquidity engaged, an inside bar accumulation occurs, the rejection block, and those 1 minute candles start printing, creating that narrative that I'm already in position to, I don't want to say assume, but in position to take advantage of that inversion opportunity. So it helps me not only be able to say, okay, this is a low risk buy opportunity, or where I want to see price ticket and run, as you say, stay in the upper portion of that, not fill it, so to speak. But it allows me also to gauge my awareness of being able to read that candle by candle by candle situation, which is helping build my confidence as well.
I liked what you said in regards to having something to fasten yourself to, because that's actually a really good choice of words, because when you don't know what you're looking for, you just know there's gaps, there's fair value gaps, there's all these things that, there are buzzwords in our community and the things that we use. But you're feeling like, which one am I going to use? Which one is the market going to use today? And by having a very specific one that you're looking for within a time based window, within 9:30 to 10 o'clock, we're waiting for that first one to form. But now when we add to it, it should act as one characteristic or another. So if it's bullish, your bias is at, and you know that the best runs occur after liquidity's been taken, it really is a good analogy. It's a really good way to fasten yourself to your chair. Don't run around the room acting crazy, trying to feel like you got to chase everything. You're waiting for a very specific event. And that in itself, until you start practicing with that perspective and using that, implementing it daily, you won't fully appreciate the level of grounding it does, where your mind's not racing. You're not worried about what you're going to miss. You know what you're looking for. You're not being distracted by other stuff. When that happens and then you engage and it delivers, that confidence goes through the roof. Your focus is limited to what you're only looking for and nothing else. And I thought that was actually a good choice of words by using the analogy of a seatbelt.
Yeah, that's someone who's risk adverse. It was really a journey of me venturing, and still is a journey of me venturing into that discomfort. So finding something, like you very well put, that you could lean on to say, okay, this is where I'm at, and let that uncertainty kind of dissipate, because it's the one thing besides risk that I can say, this is where I'm at, this is my line in the sand, this is how I'm reading it. Yeah. And allow the difficult feelings that I'm going to have to manage, go through. But I've already done the hard work on the trade aspect, like all that's done. So now I could just sit here and manage my feelings, let the stop do its job, and, just continue to read price as it moves along.
The original question that I posed to Kit and the listeners was, have you noticed an increasing number of opportunities, or maybe a measure of confidence, when the new week or new day opening gap is in play? Have you noticed an increase in your either visibility or actual opportunities that you've either participated in or at least tape read?
Yes, sir. Yes, sir. As an algorithmic signature, seeing that in itself kind of leans me towards the way. Let me rephrase that. As I'm reading price on Friday, I can kind of go in sometimes with an anticipatory idea that something's about to occur, and then to see a gap happen kind of leans me even deeper that, okay, I'm reading this correctly, and this is occurring, and then to utilize that later in the week and take advantage of, just like the first presentation, so to speak, in that fractal idea, has helped me tremendously. In-dogs, in-wogs, gaps in liquidity and efficiencies in liquidity is really the way that my mind and my eyes now have been trained through your teachings to see and read price. So yes, it has tremendously helped. Thank you.
Specifically on your Monday setups, as a follow-up retort. Focus.
Oh, sorry. That was towards me.
Yes, sir. Yes, sir.
Specifically towards the Monday setups, I'm always looking back, at what's previously been done. So it's looking at what weekly range am I looking to occur. Like, I'll just kind of give a broad example here. Like this previous week, I was looking at that weekly candle as a propulsion block. Right, so I was looking for expansion higher based off of we'd come down into a monthly order block. So I was reading the sequence as we had a down candle, then the next candle was a change in the state of delivery, then the next candle we had was an inside bar that was Passover week, so that I'm looking for this candle to come and touch the inside bar and to propel higher. So using that idea and framework with how price has opened and Monday's session liquidity and so forth, just allows me to continue to read that fractal price as it takes liquidity under the imbalance and comes above it, to use it as an inversion effect, to take advantage of that. And just reading it step by step by step by day of the week allows me to read and gauge, okay, I'm in flow, I'm engaged, I'm in flow, I'm engaged, with the right delivery sequence. If that answered the question.
Beautifully. Michael, just as an added context, focuses a high time frame liquidity paradigm trader. He definitely focuses, I would say, for anyone listening, core content month 12 within your content of the higher time frame analysis, and really how to do a correct top down analysis in how you outline price. So for any listener who would like to understand even what Focus was talking about in response to Michael, I would suggest that you go back to Michael's YouTube page and you look at and you reference Core Content Month 12, episodes 1, 2, 3, and 4. High time frame analysis, specifically. So, Michael, I just wanted to add that as a repository. We'll continue the conversation. We got a couple hands up. Want to follow back up with Alex, and then we'll hear from Trades Don't Lie, a charter student as well. We got some hands up here. Alex, we're following back up with you, buddy, with the original question.
All right, so I hope you can hear me, guys.
Yes, I believe we can. Michael, you can hear him, right? All right, good.
Yep, everything's good.
Okay, so I have, all right. I really what my question was, because I have my own model, right? I form my own model. I watch the window to 11. About that 90 minute cycle, right? Was you introduce your model. I was just ask, how do I know exactly where the next liquidity, when it's going to take the liquidity, right? For example, I'm going to be bearish or bullish. Let's say I'm going to be bearish, right? How am I going to know if that exact high, maybe the
Are you referencing, Alex? Are you referencing the 7:30 to 9 o'clock 90-minute range? What range are you referencing that you're cycling? Is that coming from the open price? Are you referencing the 9:30 to 11 o'clock price referenced earlier?
Yeah, because he modeled Venom, right? And I liked how he watched the 90. I think the 9 window, right? It was like 8 o'clock to 9:30, if I'm not wrong, to do it. And I saw that he used that entry, right? And I tried that to put that use it on my model, but sometimes I get confused because
Well, today he's referencing specifically. Today, Alex, he's referencing specifically how to map liquidity pools utilizing that 7:30 to 9 o'clock range. And when the open drive comes and the 10 o'clock price hits, you're going to be looking for between that 10 o'clock and 11 o'clock price. So that now new 90-minute range. So you have this look back range of a liquidity pool where you're looking for intermediate term highs or short term highs or lows that are being left as a stop within the market mechanics. And as fractal delivery is occurring within these time-based ranges and these specific blocks that he's outlining, you in turn are to look for and utilize the inefficiency in the liquidity pool as direction and bias towards the direction of your trade plan.
Yeah, exactly. And I entry for my inversion, right? So my entries I use inversion gaps to entry when I have a sweep of liquidity. And if I really want to get really, let's say, to be confident on the trade, I will maybe have a breaker on it. So it's gonna be kind of like a unicorn entry, but I use standard deviation to know exactly where the market is gonna go. So I like because it's a watch that 9:50 to 10:10, but I like to hold more to 12 o'clock, and it looks like the algorithm is delivering to the low of the day, or sometimes takes the previous day low, if I'm bearish, for example. Vice versa.
Okay, so Michael, what Alex is saying that his model is built around, and I know this from experience, the 950 to 1010 macro, and he's looking for liquidity pools, and you could say a silver bullet, an inversion. His model, I think, involves a lot the inversion fair value gap, and he's looking for a range to form, and he's looking to find a liquidity pool in the 950 to 1010 macro. Is that correct, Alex?
Yeah, that's correct. Yeah.
All right. So Michael, I just wanted to help convey the message to you just so you could understand what he's trying to talk about.
Okay. But was he just stating that his appreciation for it, or was there a specific question?
Did you have a specific question for it? Because as he's outlined today, he's giving you a look back range of a liquidity pool that you're referencing.
if that inversion gap is not forming, or if that's forming, right, and the market, I don't know, somehow stops me out, what should I do? I mean, what should I do? Because it maybe something else or go against me, right? And then maybe I'm not gonna enter the trade. It's gonna go in my direction. What should I wait for? Should I wait for the market to take another liquidity, or should I do something else? Because sometimes I get caught on these setups.
I think what you're asking for, I actually answered. And if I was to answer you right here, I would basically say what I already said in the space and what I've opened up with exchanging with Kit here about knowing which days, based on the economic calendar, what pool of liquidity is going to tag into. If you're bullish, let me make it very plain and simple for you. Every single day that you walk into the marketplace that you're expecting higher prices, if you have a SIBI as your first presented fair value gap, it should be a bullish inversion fair value gap. That's it. That's your mindset. Is that easy and straightforward?
Yeah.
100%.
Exactly. I use.
So if you remove all the ambiguity of which liquidity it's going to go to, because think about it, if it goes to just the pre-market session, 7 o'clock to 9:30 liquidity, which is essentially everyday process, unless it's a trending day right out the gate, then there's nothing you can do about then. Or you're going to use the London lows, or it's going to go all the way back down to a full coast-to-coast run to Asia's low. That doesn't change the fact that it's going to eventually go above the first presented fair value gap. So you're going to discover that it's not likely to do what I'm about to say here, unless there's a 10 o'clock news driver, maybe a 9:45 news driver. It will go down when it's bullish. It'll drop lower, create a SIBI as your first presented fair value gap. That way, you already know now what you're waiting for. You don't care how low it goes. Who cares? Remove the task of trying to pick the low or entering at the low. That will come over time. That's the graduated expectation of you using this information beyond the scope of what I'm showing you here. Just giving you a foundation going into, okay, I'm bullish. I want the first presented fair value gap to be a SIBI. That's how I go into the day every day. I'm looking for that. Now, if it goes in and presents itself as a BISI, no problem. Then I'm going to wait for it to do what? Treat it just like an inversion fair value gap, where I will want to see it trade back above it, then come back down and respect the lower half and not use that lower half. And then what is it doing? It's doing the same function as a bullish inversion fair value gap that I would be demanding from a SIBI that's first presented fair value gap. You don't worry about what liquidity it's going to go to until it does it. That's the first step as a trader learning under me, is you don't need to know what liquidity it's going to run for to try to enter under like a turtle soup. You didn't mention turtle soup one time that I could hear. You mentioned first presented fair value gap. And the easiest ground entry technique using them is simply let the market take whatever liquidity it wants. Then once it trades above it, trade it accordingly. You don't need to know what liquidity, in fact, you're not going to know as a new trader. And that was the whole basis of my presentation today, is I'm giving you rule-based ideas so that way you can start gaining a logical accumulation of this is what it has done more times than not. So that way you can say, okay, I know that the statistical probability of this going to that liquidity here on this day, given all the factors I've mentioned today, is so freaking high that I know that I'm patiently waiting for that to be taken. And I don't need to buy below the low or sell above that high for the liquidity purposes. That's turtle soup. It takes a lot of conviction to enter above or below old lows when you're trading with a bias. I don't care how long you've been doing it. It's just, you have to know what it is that you're doing, because it's a chasm beyond that high that you traded into going short, or below an old low when you're trying to go long. You don't know for certain how long it's going to go lower. You don't know that. But my first presented fair value gap, and as you mentioned, I was literally mouthing it when you said it. If you see a breaker there, that's like a no-brainer inversion fair value gap inside of the breaker. That's going to be before first presented fair value gap. So you have a way of testing the water with going in with one contract. See if you can get any measurement out of that. And if it starts running in your favor, your stop's going to be tight. You're going to take a loss probably. Not all the time, but you will. But then if you take a loss there, let it run up to your first presented fair value gap, where it should perform as a bullish inversion fair value gap. Then enter again there. So many times that alone will recoup the loss that you tested the waters with, or give you, if it's been favorable, give you a place to do a pyramiding opportunity where you can add another portion to the trade and then reach for the obvious buy side liquidity for a first presented partial. Take that profit and let that other one run for the daily range to see whatever you can get out of it. So that's what I would suggest to you, and be welcome to the idea that you're going to be losing sometimes, okay? Because it's real hard to ignore that factor, because it's going to hit everybody. It hits me. I mean, if I did stupid things, I would take losses just like anybody else. But I'm very, very specific about what it is I'm looking for, because I'm rule based. And that would be my only, based on what you presented here, and we got to get to somebody else because I don't want to be, too much on one person. I don't want to be here all day either. But I think this is sufficient enough. I think, and if it's not, you can obviously send me a post and I can reply to it.
This is absolutely fantastic. I think anybody and everybody's going to go back and absolutely love everything about this. So, we're going over some very, very detailed and precise algorithmic principles within the content that you've conveyed to people who are very, very passionate and have an extreme sense of urgency in implying and applying these concepts to the charts. So that's why we're here. That's why we do what we do. That's why we love doing what we do. And I'd like to hear from maybe one or two other people, and we're going to try and keep it brief and concise, and we're going to respect Michael and his time, and we're going to wrap things up. So I think that's fair to the man. If that's okay, Michael, we'll take one or two more questions, and then
I'll do three more.
Okay, sounds great. We're gonna go trades don't lie. I'm gonna go with him first, and I got Sam coming up, and we'll pick the third one. But trades don't lie. Jump in here, brother. I know he's an ICT charter.
Hey, can you hear me?
Yes, we can hear you, brother.
All right, Michael, you can hear me? I
Yes,
appreciate you. Thank you very much. I just actually got done drinking like a very large espresso. So if my voice seems jittery, it's
good. Hopped up,
Yeah, man, I'm,
caffeinated
ready to
charters
go.
are great.
So I am in alumni user group 01. So I am a charter member. I've been with you since 2019. And I just want to give you thanks, and I appreciate you for everything you've taught me. You've changed my life. So thank you very much. I do want to continue the conversation on first percent of fair value gaps, because I did just codify a indicator that I can actually pull data from the database and take every single 1 minute candle going back as far as I can, however many days. It can go back as far as 500 days if I would like, to see the first percentage fair value gap in any time filter that I choose. And I have 5 different filters, or I can add more, take away. It doesn't really matter. I could add midnight if I wanted to. You could look at the first one from midnight or 9:30, but I actually also implemented filters that will allow me to see the first weekly percentage fair value gap and monthly. And then the other addition to this indicator is, and I believe personally, this is just my observation through my own study, I enabled the ability to see not just the first presented fair value gap, but also if the first presented fair value gap is a BISI, then it will also show me the first SIBI that is created in the session as well. Kind of like another layer to it, another array to look for. Mm-hmm. And I just wanted your thoughts on that and my study and the indicator, and what you think about using previous days, how far back we should look, using the weeklies and the monthlies, and if I should be using the 1 minute data, or if you recommend using higher time frame data for these arrays.
Well, first, I would love to see what your initial findings show. And as far as it relates to how far you look back, I kind of want to keep it germane to the if the data ranges, which is the 20, 40, 60. There's going to be lots of instances, if you went through broker statements, you would see that I was using things that's beyond 60 days. But they require other things and experience. Not that it's super secret. It just means that I'm more comfortable using them. So while I don't think they go stale, but the easiest ones, the most salient ones to present market conditions, are going to be within the scope of 60 days. The most sensitive ones are going to be within the last 20 days. And if you're working with the weekly range objectives by determining bias, just stick with whatever the first Monday, first percent fair value gap is, and then use that throughout the week, and then every individual one for that pertinent week.
Okay.
So don't try to. I mean, I understand it as a person that is really interested in facts and figures and stuff, and I love that. You know, I'm a numbers geek about it. Don't drown it out and remove the purity that the opportunity of you using a tool like this will yield to you, because you can drown it with all kinds of stuff, and if you torture the data enough, it's going to submit to anything. So if you use the simplest rules of saying, okay, what's the pertinent value of first presented value of the week, and then every individual day by day throughout the week itself that you're on, and then go back 20 days. Do the majority of your initial research with just the last 20 days look back. I'm interested in seeing what your figures reflect.
Yeah, I will definitely look through that.
I have a quick follow-up question to that. The term or idea of mitigation, Michael, as in how often Price has printed and or revisited a given array. Do you add context to this idea or philosophy of whether a price is kind of being opened and left open versus being mitigated or unmitigated? Does that make sense?
I don't know really what you're aiming at there, because at first I thought, okay, well, this is going to be easy to answer. Then it's like, because what you're saying is essentially what I've taught in regards to breakaway gaps, where I want to see certain things stay open. So in fact, I do spend time, I've taught and spent lecture time doing it, where I want to see certain specific fair value gaps left open.
But okay,
for instance, let's go back.
I didn't mean to interrupt. Go ahead.
Let's go back to Alex's portion where he was talking about how he liked breakers. And I told you that if there's a fair value gap in that leg of the breaker when it reaches down for that liquidity, that it can be used if it's a bullish scenario and it's a bullish breaker. You don't need to wait for it to go above the breaker high and then come back into it. So I can use that first gap. It's a fair value gap. If it's a SIBI inside that leg that gets the liquidity, once it trades above that, I'll test the waters right there and go with one contract. If I'm really, really bullish, I'll just go in and just start building my position there. 6 contracts, 4 contracts, 2 contracts, 1 contract. Well, if I see it go above that SIBI and it's a breaker, and it runs and doesn't even come back to it at all and goes right to the breaker, what do you think my mindset would be about that fair value gap? Do you think I would want to see it filled in or being left open?
A breakaway.
Exactly. So that's one way of using liquidity, the run on liquidity, and then anticipating the potential for that fair value gap in the leg that makes that bullish breaker being used as an inversion fair value gap. But if it fails to present that at all, I definitely want to see it left open now. So hopefully I kind of...
Yes, 100%, 100%. That's kind of where I was going with where and how price returns to specific arrays and kind of mitigates them versus leaving other ones open, and that sensitivity there. So you explained that perfectly. Thank you. That was exactly the question.
Yeah, the way that my mind worked with when you asked the mitigation question was thinking of, the inverse, the things that are left open, right? And my mind immediately went to regular trading hours gaps and how we track them, and it leaves an open part and it didn't fill the gap all the way, and then how we can use that later in time as a draw on liquidity, being like quote unquote, we call it naked, leaving it open. Like, we need to put some clothes on that is the joke that we have. But yeah,
that again, I'm kind of asking. This is kind of a concept that I built on from your teachings. So I'm asking more personally and inquiring as far as this idea of a array forming versus it being priced back to or not, and or it being opened and or left for future strategic liquidity runs or inefficiencies for latter parts of subsequent cycles or time-based ranges even.
But yeah, I appreciate you. I just wanted to ask questions about the first percent fair value gap indicator, and I will try to not use 100 days worth of data, because it does get a little messy and a little noisy, and we like to keep our charts clean. And I appreciate you saying, if you twist the data so much, it's going to conform, right? So even though I might be seeing turning points, and body closures exactly on arrays from very far out, it might just be coincidence, or it might just be torturing the data a little.
I would go so far as to say it's coincidence, but it is going to be something that it's going to be hard to fashion a rhyme or reason how and why you would use that one at any given time. That's kind of like the only thing that I'm agreeing with by saying beyond 60 days, there's things that we have never addressed in the teachings that I've presented that would ever allow for you to have a quote unquote model to employ for that given circumstance. You know what I'm saying? So while I will use an old one like that when it fits what I'm looking for, a listener or a student of mine, I would not expect them to have any affinity for something past 60 days because there's no necessity for it. I mean, you have a universe that's rich with all the opportunities that anyone would ever want just in the last 20 days, let alone go into the full spectrum of 60 days look back. So just kind of like keep that in mind, because then it'll be a lot more rewarding for you because it'll fit everything I've already taught and it'll dovetail nicely. I have data with what I've done with very similar things. There's a lot of things I have already automated. Like I don't need to be in front of the charts and do these things. I can just turn it on and it just does it. So I'm interested to see if your data is germane to what it is I've seen in my own work.
Yeah, I will. I'm going to gather more data for sure. Yeah, and then the only other question, and then I'll let someone else go, is it's definitely, I would think that it's worth identifying not just the first BISI, but also the first SIBI. I mean, to me, it's just so beautiful to codify and see both of those arrays, because logically as a charter student, that's how I would perceive you seeing it.
Well, I'll come out and say, I'll tell you, you are talking about a PD array that I've never released, but there's something to it. When you see the very first percent of fair value gap, whatever it is, whatever the contrary is to that, the very first formation of that, it's useful information.
Thank you, sir. I appreciate you. And yeah, I'm going to hit the study books. And Kit, I'm going to let someone else take over. Thank you guys very much.
It wouldn't be Trader Roundup if it were not a little extra saucy, Michael, okay? So it definitely seems a little saucy in the room, okay? So, yeah, we love it. We love it. We love it. We heard from Trades Don't Lie. My boy Pippi, I'd be remiss not to bring him up. We've got one more speaker, and Sam. It'll go Sam, then Pippi is how we'll probably finish the day off. I got Neil here too. Much love, much respect. We are gonna limit our speakers. We are wrapping up. We've got two more of three per the request of Michael. Sam, you want to jump in here? You were legitimately up next. I think.
Thank you, man. Because really, I don't get a chance to speak to ICT often. And when I do, I have to sift through my mind just to figure out what question to ask him in the first place. Because he explains so much every day for us. And I'm a student from 2016. I started off in London a very, very long time ago. And we found your account on Baby Pips, and like everyone started talking about order blocks. Everyone in London started talking about order blocks in 2016 when ICT came out on Baby Pips. It was the most amazing thing. And from there, we started growing as a community. And I still have his whole 2016 mentorship logged in Google Drive. It's still there. So I have his old stuff. So like when I look at his new stuff, all I look at is refinement of what he's been saying for years. You know, it's just refinement.
Yes.
So when I
salient?
when I ask him, what I want to really ask him is, as a student that's been observing the market since that time, I noticed how, like, I started off in Forex, and now I really just trade gold. I don't care about anything else. I don't care about money that much anyway. So, what?
Can I ask your frequency of trade when you're trading gold?
I'm a part-time trader. Like I'll take like a $500 and max out the account with one trade. If it goes through, it goes through. And with your method, it's so accurate. I don't falter.
Yeah, well,
I don't falter with the 500 being lost. I've got like my accounts that are I'm not trading. I'm into real estate in Africa. That's my main business with my mother. But
if I may, my question is, what is the level of frequency? How often do you try to assume a trade or engage gold?
Like I said, okay, I was going to go into that. I'm ADHD autistic.
I'm sorry.
My personality doesn't allow me to be in the markets as frequent as everyone else. The way I saw you max out like you did 5,000 to three, I think it was $5,000 to 3 million in a space of, I think it was like, it was so short a time that we actually got into an argument.
Couple
It
months.
was once upon a time, and we actually got into an argument online. And I said, it's impossible that you did it because for my personality, I get too excited. I don't know how to focus and be that accurate with my trading because I know the information. It's just like my mind jumbles up when I saw you do it, and I guess for me, that personality, I can't achieve that. And like I love what you said when you first started out as a teacher. You said, be a sniper, cherry pick, find that one thing in the week that matches your personality, and you take it. That's what in my mind, I became a sniper that day. I don't want to take every trade. I can literally wait the whole month and catch one sweet one sweet tray that's set up that just it keeps you eating with your bills and everything is paid for with that one trade. That's how I approach it now. I don't look in the markets and I don't want to be there every single time because my personality doesn't allow me to. I get too excited. My edge runs hot and I think I'm invincible. I hate that about myself. You know, as a trader, I absolutely hate the fact that I get too excited about the money that I'm making and I start imagining what I can do with the money. So I limit myself. I tell myself, I just want to pay bills. You know, I don't want to be that guy that makes 3 million in a month and says, fuck it, let's go to Vegas. You know, because you can't fucking do that. You can make that 3 million and fucking go to Vegas and have a fear and self-loathing for the next 3 months. I have that weird personality. I love adventure. You know, I see lions a lot. I see hyenas a lot. Like the wilderness for me is better because it's quieter. But you see, with money, you're tempted to do the stupid things with money. And for me, it's all about the stupid things you do in between those good trades. And for me, it's difficult because I come from a neighborhood, you know, where people flashed money and were drug dealing. I come from a bad neighborhood. You know, I was in London. Yeah, you had two choices: listen to ICT or sell crack. So
That's a choice, isn't it?
you've got two choices in London. I mean, London is a financial capital. You have two choices when you go into school. You either become a tradesman, you do electricity or whatever, like electrician or whatever, or you trade stocks, or you struggle. You have no choice in that area. So I come from that. You know, I was hungry when I saw ICT in 2016. I was like, this is it. And one thing I want to ask him when I really look into his work, when he says he's not going to teach you anything, he can't, because what he's doing is refinement. And refinement is literally a lifelong task. It's like chess. Chess started off so simple. It made Paul Morphy look like a genius. But now we have Magnus. You understand? And we have computers alongside Magnus. So like chess is even to a point where it's nearly solved. It's getting boring now. I mean, you find the
Okay,
moves
you're
better.
losing me, buddy.
But like it's one of them ones now where you have to understand something. Where obviously I'm ADHD autistic, so like when I talk, I
No, I
rant and
got
I
you. I'm
go
just trying
over.
to reel you back
So
in here. We
yeah,
got some folks here. I'm just
yeah.
trying to reel
What I
you
want to
back
ask
in.
what I want to ask is where in terms of refinement, like we went from looking at just the high of the week, low of the week is going on Tuesday, because I remember the old stuff. In terms of refinement, now we're looking at new weekly open. What is next? Is there anything next? Is there anything? Because what I noticed is from 2020 to 2024, the markets have changed in the sense that you can't trade Euro USD the same way you used to back in 2016 to 2020. The algo, you say the algo doesn't change, but it kind of does. It in a way that like you can't trade Euro USD the way you used to. It used to be my baby. I could trade it any day, but
No,
now it's like
that's not the algo trading. I mean, that's not the algos changing. It's the state of delivery, and from a macro perspective, that's changed for a period of time.
yeah.
It's the state of volatility. Think about what's happened, in well
Thank you,
the
thank you,
last
thank you. Let
five
me let me
years.
let me get off now. Let me get off.
We went through COVID. They shut down the entire world. They disrupted global commerce. They they wrecked the minds and peace of mind of nearly everyone that was believing all that horseshit. So we're still getting through all of the damage that was done psychologically to a lot of people. And a lot of big firms don't exist anymore. A lot of brokerage firms were harmed in that. Traders were harmed in that. So it's not that they changed the algorithm. They disrupted. This was kind of like what I was warning. In 2016, I used to do Twitter Spaces, and I talked about how they were going to use Trump. They were going to let him in, and he was going to be the fall guy. They're going to let him build this collection of people that swore an allegiance to this man, who has no experience doing what he's doing, but he's a businessman. And since the American continent and country is a corporation, and everyone that's born and given a social security number is a slave to that corporation, they are forced to work and give their money and proceeds to this corporation, or they have the experience of losing their freedom, okay, or be penalized. This whole thing from 2016's conversation has been an unfolding of everything I've outlined. And we're in the latter stages of that. They have something that works. This algorithm is absolutely like mind control to speculators. They're not aware of it. The people that kick and scream and say there is no algorithm, but they're forced to look at the data that we present and saying, here's the continuity of what I'm saying is going to happen in the marketplace. It's not anchored to anything else. So when someone says, and like yourself say, and I mean this with all due respect, I just want to correct you where there is no changing of this algorithm. They have worked so hard to place it in every instrument, and the amount of money that they control. It's not about them always making money with it. It's not what it is. It's the control of wealth. It's the control and disbursement of the transition from wealth to wealth. Who gets it right now? Who's not allowed to have it right now? Who's being punished? There's a whole lot of things that's going on behind the scenes that I'm not going to delve into because, number one, we've never had the time to. I'm just not going to do it. Let's put it that way, because I'm already touching on things I said I wouldn't talk about anymore. But we're seeing a time in history where they created this boogeyman. COVID is this invisible killer that only will kill you if you stand up in a restaurant. But as long as you're wearing your mask, if you're standing up, or take your mask off below like a poker room that's full of smoke. You walk through it, the upper half of the room is full of smoke. But if you get down real low, you're afraid. You won't have to be afraid of breathing any smoke. They created this illusion of this monster that's going to get you. And people are still afraid of it. They're driving around with their mask on and alone in their cars. So there's been damage that's been done. It was an IQ test. It was a beta test. The real thing is coming. The real thing is going to come. And at that time, it's going to feel like they changed their algorithm. But they're just going to go to another level, a more intense version of what we just saw, where the market will absolutely be untradeable for a short period of time. It's meant for wealth distribution. It's going to be taken away from 401k holders. It's going to take away all that wealth that's there. Even your baby Bitcoin is going to feel this because there's so much money there to plunder.
That's making me feel sick.
Well, you shouldn't feel sick. You shouldn't feel sick because, number one, the average person doesn't see it coming. And when it happens, they're going to be very anxious. They're going to be very scared. They're going to feel like this is the end of the world, and I'm never going to be able to find a way out of this. And for some, that's probably going to be true. But since I'm trying to tell you in advance that these are the types of things that we're going to see, do you not see Trump being set up as a fall guy? Can you see that? Like, he's doing all these things, but we haven't seen any of the lists.
Let's not even get political.
We haven't really.
Let's not do that.
No. I want to tap into this for a second because we turned that leaf over. So let me just talk a little bit about it.
I don't want to get you in trouble.
It's okay. I'm going to talk about headlines. I'm not talking about anything new and fresh. The fact that all these things were promised, but we're not really seeing it. We're seeing a little bit of people get deported, but really we're not seeing any of that stuff. We're seeing reasons for people to be in the streets this summer going at each other's throats. That's what we're seeing. All this is theater. So when you see the reverberations from all these things, and it translates into market volatility, when it becomes unsafe to go out there and go into stores and shop, and commerce starts to dip because of that, they're going to come up with all these narratives that saying this is why it's happening, and this is why it's going to happen. It's going to get worse. It's going to get worse. And then people are going to be fearful in trading. And then they're going to start creating these gaps in liquidity. That gap in liquidity, nobody's going to not want to get out of their stuff.
That's insane.
They're going to want to
That's
sell.
insane. That's insane.
But there's going to be so much of a disparity between where they allow price to be at right now and how far they drop it down because they want to lock in a premium. They want to lock in a premium to what's available to be plundered. And that's going to be untradeable. You're not going to be able to trade that portion of it. So because I'm telling you in advance, now 9 years ago, it takes a long time for these macro events to take place. As I said back then, I said, it's not going to happen tomorrow, but you got to prepare yourself for it. And here we're at his swan song. He's in his second term, and he went in promising a lot of stuff, and he's not delivering on very much. And I'm telling you that we're going to see another example of extreme volatility in the marketplace. And it will be jarring. It will be unsettling. But let's be fair. Okay, you said that you're trying to work with $500 and you're trading gold. Gold, to me, is an event-driven market. I don't think it should be traded every single day. Personally, it doesn't fit my personality. And that's why I was interested in asking you, what was your frequency of trade? How often do you take a trade in it? And my next question would have been, and we don't have to answer it, but you can send it to me in a post, like what is the model that you trade when you're trading gold?